Righto, g'day traders. What I'm doing here is recording the last week of the E-minis mentoring program. So we've already done this particular session, but it occurred to me that it'd be a good one to record and put up on the blog. So this has not actually been done live in front of you guys. It's actually been recorded afterwards. So the first thing is, well done on completing the E-minis mentoring program. We're nearly a year into it now, and I'm sure you guys, like we spoke about last week, have seen yourselves come such a long way. You think back to where you start off, where you just literally getting started with trading and learning the real basics and introductory information, and now you should be at the stage where you're developing quite comprehensive risk models and developing your own systems and really going ahead with belief and confidence. So final week, sat down and thought about what needs to be said in the final week, and it's all about empowering you to go out there and be successful. Having the belief in yourself that you can absolutely do this. Many people have traded these exact same markets, and become very successful in day trading. Why can't you do it? You've got the information, you've got the content. What it really comes down to is having that empowerment to do it and believing in yourself. And if other people have done it, there's absolutely no reason why you can't do it as well. And have absolute belief and confidence that you absolutely can do it. So tonight, in regard to that sort of empowering you to become successful, I want to talk or look at two things. Really just finish off with risk models. Risk models is just the absolute key to success. For me, it was absolutely changed my trading career, and it's really needs to be the hero of or what your trading system and your trading business is based on. Okay, so just finishing off with some stuff about risk models and looking at another example of risk models. So I'll do that right then. Just a simple technique, or just a simple example, sorry, I should say, of how you can, make your systems better by looking at risk models. So it's an example which I'll take you through at the end. It's not necessarily might be something that you want to literally take on board, but the idea is to show you how just with a bit of thought and just thinking outside the box, you can do many things to improve your system. Constantly, every month you should be looking to, and every year, of course, looking to improve your systems. And then the second thing I want to look at is really look at the power of compounding. So you need a vision. You need to see, where this can potentially take you. If you look at the reward that you're getting from your effort right now, of course, the reward's not there. That's the case with any business right at the start. So if you're we're basing everything on what you're getting right now, of course you wouldn't continue because it's just not worth it. But what you want to see is have a vision for that future and really look at where this can take you and be inspired by that, and that's what's going to give you the motivation to go on. That's what keeps you getting up every day and pushing forwards. So looking at risk models here, so obviously the last 5-6 months, it's all been about risk models. The whole program is designed just to lead you up to sort of getting to the stage where you can comprehend and understand how to create risk models, and then just going ahead and just really breaking down what risk models are. So looking over the last couple of months, there's two main reasons why you'd build a solid risk model which you attach to your trading system. So remember, the risk models, it's broken down into many different elements, but it's what you base being profitable on. So it's like your feasibility plan or your financial statement as to whether your system is actually going to become profitable. Okay, and that's what you need to work with. So you can break a risk model down into two essential parts. The first part is making sure the base system that you're operating with is feasible and profitable. So a base system, it doesn't have to be complicated. Sometimes the best things are the simple things. But what you want to do is just first of all make sure that you're starting off with a profitable or a good base. Okay, if you find it's not, no issue. Just move on and find something that is going to work a little bit better. Okay, so starting with a solid base, making sure you've got room to work with, and then two is always finding ways to make the system better and make it more efficient and more profitable. That's a constant process. So taking that base, that's already a good start, and then making it better and going through the different elements of risk models. Drawdown, expectancy, frequency, all those sort of things, and making sure you're always looking to make your system better. So just to sort of prove the point that I just wanted to do a bit of an example here. I was talking to a friend yesterday, and she's starting up her own business. And what I think, if you look at risk models and what I've said here in regards to the two steps or the two reasons why you'd go ahead and build a risk model, it's applicable to absolutely every business in the world. It's not like just trading. Creating risk models or having a a financial statement that sort of tells you a lot about how you're operating is absolute, paramount for every single business that's operating in this world. So, I was listening to my friend talking about opening up their new business, and I was just sitting there like always, sort of relating it back to trading, and I could really see the connection there. So this particular person was talking about starting a business. In a cafe and looking at the hospitality industry. So they've been doing a business course at TAFE and looking through that. And basically what they talked about in there is very similar to this, risk models. They don't call it risk models. I think they were calling it a feasibility plan, or basically looking at doing a financial summary for yourself and working out, okay, your business model, your business plan, let's make sure it's profitable before you go out there and spend all this time and capital on actually going ahead and doing that. I think that's a problem is many people get, they might be a little bit excited, might just get going before doing a really strong business plan, whether that be trading or whether it be opening a shop or, anything. I know it's definitely the case for me. I got going with my trading live, too early. I didn't know that I need to do this stuff. You live and learn, but I certainly would build very comprehensive risk models now before I do anything new in regards to my trading. So, this particular person, they wanted to start their own business and do a little cafe in Melbourne. They went through, and like they were told at the TAFE courses, do their financial summary or do their risk models, okay? Now, when she did this, she just couldn't make the business profitable. She looked at it, it just wasn't going to be any reward for her effort there. She found she was just better off actually working at a cafe. She worked out that after years and years of work, it might make money, it might not. It was really sort of on the edge there, and there wasn't any sort of light at the end of the tunnel. It's sort of, here's this business that she wants to start, but the warning bells were saying that if you're going to go about this way, it's going to be really tough, and the chances are you're going to become another statistic. Okay, so that's the idea of a risk model. So, she thought, okay, what's the use of starting this particular business venture when I'm better off just working for someone? Okay, but the thing is, the goal, you can't move away from your goals. The goal for her is to be a business owner, not working for someone else, being a business owner, being in control, and and working in the hospitality industry. She got a passion for hospitality. So back to the drawing board. So basically, step one, making sure the system or the business model operates and it can be profitable. She found it wasn't the case. She needed to go back to the drawing board, change a few things around. From there, she found a better business model that works. So looking at doing some catering. Working out of a van. So this all of a sudden eliminated lease costs and a few things like that. So all of a sudden the costs really dropped, and she wanted to operate from a van doing some catering services. Did up the feasibility plan or looked at the risk models, and all of a sudden it started to make sense. There was some big profit in it, so it was a really good base system to start with, and everything was looking a lot more feasible. And this is the same as a risk model. All of a sudden you find a base, you find something that makes sense, that works, it lines up with your objectives, so you go ahead and you see it, that it's working, and then you go ahead and then you start spending the time and effort and the money and the capital because you've got a good base to start with. So that's sort of step one of a risk model, and relating it to another business, a cafe for example. That wasn't going to work. Switched the business model to still within the industry, but a catering service out of a van, and that was more profitable, or it's going to work out to be profitable based on the risk models in place. Okay. Step two then is to find ways to make that base system or that base business more efficient. So, when she spoke about this, even though she doesn't specifically know, about these 2 points that we're talking about here, but it's all relevant. She said it, as far as moving ahead and making the system more efficient, it's about being aware, really testing and, it's trial and error, recording information, and also being very open-minded. And basing decisions on facts rather than assumptions. So many times I think many businesses don't go anywhere because it's just based on assumptions that it's going to work, rather than actually taking the time to create a really good risk model or feasibility plan based on facts to see that's going to work. So she said, needs to base decisions on facts rather than assumptions, and being open-minded, and always using trial and error and testing and recording. Okay. So what that meant for her is she's going to be open to all business opportunities. So at the moment, looking at out of a van, doing this catering, doing healthy alternatives, that's obviously a real buzz thing at the moment. Doing kids parties, also doing high teas, that's another really quite popular thing at the moment. And working with a few different things, and then recording the information and seeing which of those sort of different ventures is working for us. So she believes that high teas is something that should be quite profitable. It's obviously something that's a bit fashionable at the moment, but that's just an assumption. She's going to base her actual decisions on facts and then see whether that works out. But whatever sort of part of the business takes off, that's where she's going to really focus and look to build that and make it more efficient. So she's, step two, building the business by recording and using trial and error, and then focusing on the areas that are working. So it's the same with trading. We take our base system and we're always looking at ways to make it more efficient. So that's what I'm actually going to just show you an example of that just at the end, not right now. I'll continue on, but I'll show you a way of, just something I did that took me half a day to sort of work a few things. And what I basically did is found a way to make my system a little bit more efficient and add about 10 points a year to it. Increase the profitability by a good 20-25%. Depending on the amount of contracts you're trading, that might not mean so much of this now. But 11 points in a year when you as you move forward in your trading business, that can be thousands and thousands of dollars. It's really worth your while. So I'll show you a little practical example of that in a second. But just to sort of finish off this page, the point is risk models, however you describe them, whatever business you're a part of. Obviously, we're talking about trading here, and then making an example in relation to the hospitality industry. But they're absolute key to success, and everything, it'll tell you everything in regards to your future in trading. So risk models, and it needs to all sort of work and come through your risk models before you ever trade one single live dollar in the market. That's just very important in this final session, just really making sure that you've got that very clearly in your mind, that risk models is what it's all about. And then let me just bring up another sheet here. So just moving on, as far as, still talking about, being empowered and really thinking about, how you can become successful. So just sort of getting a little bit broader for a second. So that's, risk models is really the content side of things. If we take a little bit more of a look from an overall perspective, I got there to create a successful trading business, you need to remember these 3 points. Okay, so just, these are the three things when you break it down. This is what needs to be there. Okay, so the first thing absolutely is belief in yourself and believe that it's possible. We talked a lot about that over this year and working on yourself. If you don't have the right mindset, it doesn't matter how good a system you have. Like the right mindset with just the most basic system will always beat hands down someone with a not so good mindset that has a great system. Okay, so meaning mindset, psychology, it's more than half the issue here. It's everything to do with being successful or achieving anything in life. Whether it's to lose weight or have better relationships with your kid's spouse, or to be successful in business. You need to believe it first before possible. You can think of many examples where nothing you achieve in life happens until you first believe it's possible. Some of the biggest things in the world, going to the moon and things like that. First of all, someone had to believe it's physically possible, otherwise it never happens. So believe it can be done. Absolute paramount to success. So just think about that every day and just really work on belief every day. And remember, like I said before, many have been in this exact same scenario before and made done really well out of a trading business, done really, really well. So, why not you? That's the thing you've got to remember. It's not like you have to be the pioneer here and create something brand new and invent the light bulb or anything like that. You got the content, you got the sort of more information than 99% of people. You sort of hopefully you got the belief more than 99% of the people. All you just need is that bit of belief in yourself and a few of these other things here like work ethic and vision, which we're going to go through. And absolutely no reason why you can't have a successful trading business. So remember that and think about that every single day. Point 2 there is have a strong work ethic. Do the work, but do it smartly, and work with your strengths. You really need a strong work ethic and an attitude of not giving back, not giving up. It comes back to step 1 and believing yourself, backing yourself. All the successful people in the world, they've all come across hurdles and obstacles and things like that, but they just keep pushing back and keep on moving forward. So guaranteed you already have and will have many more obstacles, but you just need to have that work ethic that you're prepared to work through it and get over it. Obviously the workload will drop off as you start to proceed. It's like that snowball. It's sort of once it gets rolling, you can sort of sit back and, it's not always going to be this big grind, and once you sort of start seeing some profitability too, it's sort of, okay, now I'm getting this, and that will start to really have a flow-on effect and do wonders for your belief and everything as well. But at the start, it's getting this big machine rolling, and No doubt it takes work, and there's just got to be a work ethic there. It's not just enough to have all the sort of the information, the belief. It's very very important stuff, but you need to just head down and work at the start. A million. Quite often say, well, what does $1 million business look like? If you want $1 million business, are you putting in that $1 million effort, or does your business look like $1 million business should look like? That doesn't mean you have to work 24/7. Like, a work ethic, yes, but working smartly and working on all the major areas. So believing in yourself, having that work ethic, and then like working. So I said before, work ethic, but work smartly. So you want to make sure you're working to your strengths. It's very important that you base a system on your objectives as a trader. So Trade Your Way to Financial Freedom by Van Tharp. There's a complete chapter at the start of that book that talks about basing everything on your objectives. Okay, so he says one of the most important things about trading is, firstly, before you really do anything, and if you haven't done this, sort of go back and do it, is really sit down and go, okay, don't worry about the system for a second, don't even worry about risk models for a second. Just say, okay, what sort of trader are you? What do you want to do? Like, what sort of markets do you want to trade? What time frame do you want to trade? What sort of systems do you want to put in place? Do you want to go for systems that have a high strike rate but small winning trades, or do you want systems where you're not so don't really care about the strike rate? You're looking for those bigger winning trades, so more trend following and things like like a 5-to-1 or a 4-to-1 ratio, or are you happy to work with a 1-to-1 ratio, or even a 1-to-2 ratio where your risk is bigger than reward, but you take those little small chunks all the time? There's many, many different ways to trade. They all work, but you've got to really sit down and decide, what are your objectives first, and then you look for something based on that. For me, when I trade, I really like about a 2-to-1, 3-to-1, 4-to-1 ratio of reward to risk. So my profit target, whatever I'm risking, I need to be in a situation where I gain at least 2 to 3 to 4 times what I'm risking. Okay, that suits me. So in the room at the moment, we've got a system that Seba has used. It's a breakout system. Quite often it starts off with a 1-to-2 reward risk ratio, meaning the profit target is about half the size of the risk, or the risk is twice as big as the profit. Okay, the thing is, but the system works. We're actually doing a case study on the moment. We're going through doing some building a risk model on it, and it's looking quite good. And I can really look at the system and go, yeah, it makes sense, and to me it looks like it will work. And there's nothing wrong with the system, but it just doesn't meet with my objectives. It's not my type of system. Doesn't mean someone else won't trade it. Doesn't mean it won't work. It just doesn't. It's just an example of it doesn't meet with my objectives. So it's very hard for me to keep on working hard with something like that when it's sort of not meshing with my objectives. So remember, keep everything in line with your objectives, and that's working to your strengths. So as far as doing the work, in creating risk models, it's sort of, step one is start with that base, work until you have something that's worth pursuing. Then once you find something worth pursuing that's based on your objectives as a trader, you want to build upon that base. That the base doesn't have to be spectacular. Sometimes, like I said before, the simplest things are the best. But remember, the risk models are the hero here, not necessarily the system. Okay. As far as I'm concerned, with a system, for me, again, if it lining up with my objectives, I look for something that's as automatic as possible. So I want to put as many automatic things in place as possible. So I have to make less decisions. I'd rather do the work and set everything up and build the system, and then when it comes to crunch time, let the sort of system run itself while I'm there overseeing it. Okay, I still have discretional parts. I can't avoid the discretional side of things. I really like to watch other markets and use that to sort of influence my trading, but very much most of it there is an automatic process. But that automatic process isn't something that's just set and forget. It's always being refined and developed. It's like that. The first PowerPoint, we did those case studies on a couple of different entries, and we found the first PowerPoint as a base is a really good system to start with. It has a strike rate well over 50%. So if all you did was take the first PowerPoint of the day, that's a system to work with. Whether it made profit every single year, who knows? But you add a few things to it. You look at a few different ways to make the entry a little bit more dynamic. You use a few different profit targets. So I go for bigger profits when the markets are ranging more, and smaller profit targets when the markets are tighter. So there's sort of all sorts of different parts of the system which makes it a little bit more dynamic in moving ahead. In fact, in a second I'll show you an example of how to go ahead and just by adding something to the first PowerPoint just to make it better and sort of have a little bit more of a dynamic entry rather than just sitting there taking the first PowerPoint every day. But I'll take you through and show you the example in a second. Third point there, you have a vision. Vision is where you're going. Okay, so inspire yourself. Like I said before, if you focus on the now and the reward you're getting for your current effort, it'd be really hard to continue. You must, whether you're making, you might be making a loss, or you might spend all this year and make $1,000, and then you might build it up to $20,000 a year, then $50,000 a year, then $500,000 a year, $1,000,000 a year, whatever it is, you keep on building it up. But if you really focus on the now, of course, it's going to be very hard to be inspired by that. But that's where you sort of go, okay, I'm building these really strong risk models. I've got a system that's very well structured. I know year after year I can produce X amount of points. It's sort of the pressure's off, and all I need to do is just keep on building up, building it up, building up, and then you go through, say, a bit of a compounding calculator situation, which we'll do now, and you can see where this can take you. By doing the same thing, what made you $3,000 this year might make you $1 million in 10 years. Okay, but have that vision. Set yourself a bit of a roadmap to follow. And it's about starting with the end in mind, and then working backwards from there. So let me show you what I mean by that. Let's bring up a compounding calculator and have a look at a few things. Okay, here it is here. So compounding calculator up. Let me just get rid of a few things. Sorry, wrong one. Where are we? Let me just find it. There it is. Okay. Spreadsheet. We've talked a little bit about spreadsheets, Excel spreadsheets. They're great. Really suggest you learn spreadsheets because it'll really make your research and development a lot quicker in the future if you don't know much about Excel spreadsheets yet. But what I got here is just, firstly, there's sort of two figures in yellow that can be changed. Okay, obviously, when changing these figures will dramatically change this down here, which is the return on investment, which is what we're really is the main focus. What your return on investment will really have an impact on what you'll make, and then taking that return on investment and multiplying it by these different amounts and seeing what you can be worth in 10, 20 years. Okay, so as far as some figures here, I'll use $3,500 contracts. That's pretty good. If you're risking 4 or 5 ticks per trade, you're looking at about a 1.5% risk per trade. Okay, so if you had 10 losing trades in a row, you might risk, say, about 15% of your account, which is fairly that's fairly manageable. But again, it comes back to your personality and your objectives as a trader, and really work it out. It's not enough just to sort of base it on assumption, base it on facts. So go through what we went through in previous sessions, and that's all available on the blog, and use the formulas for working out what you should be trading, what your position sizing should be, what you should trade per contract. Okay, if you've got a $100,000 account and you don't want to ever risk more than 20% of it, that means you don't want to risk more than, say, $20,000 out of $100,000. We'll work out what your contract size should be. So if you go through and work out your worst losing streak was say 30 points, that good or bad, who really knows? But what you got to do is take that 30 points and work out, okay, if I have a 30-point losing streak again, based on this size contracts, I won't risk more than 20% of my account, or whatever it is. There's specific formulas there to make sure you get it right based on actual facts. Okay. And then the next point is there. How many points do you want to achieve a year? 30 points a year. Might not sound like much. I mean that's say about 3 points a month in trading 10 months of the year, having a couple of months off. That's very, very, very achievable. That's nothing sort of outstanding, but it's, if you would achieve 30 points every year and start putting that together, I mean, you can go wherever you want with that. Okay, and it's sort of getting away from that, I must achieve a certain amount of points per month, or even per week or per month. That's where the pressure really can start to come, and look at it more of a yearly thing. For me, 30 points is a great figure, and from then you can just build upon that. But very, very achievable. You can see, obviously, if you change it, if you got 50 points, it goes from 43 per annum return to 71%. Okay, so it really chops and changes, but 30 points, 3 points a month roughly on average. But again, don't really look at it monthly because there's going to be losing months, there's going to be good months. Just looking at it, going, okay, over this next 12 months, putting together something that can make me 30 points, um, will do amazing things. As like I said, there's a little example I'm going to go through here where I put together a few things and it increased the system by 10, 11 points in a year. That makes a massive change to your return on investment. Okay, so just work with realistic figures, but work with something that at the same time is going to push you a little bit. You don't ever want to just have it easy, but you want to have something that's very much achievable as well. You don't want to sort of sit out there going for 2 points a week and sort of being really bombarded by that and under the pressure and sort of really crumbling under that pressure. You want to start off with just go for 20 points or 30 points in a year and just make sure you start that progression forwards. Okay, and you'll see 43% per annum, which is $3,500 contracts, 30 points, can take you anywhere you want. So then you go in here, you just go equals that multiplied by 43%, that is. Okay, and then you sort of just bring it down like that, and all of a sudden $3,000, you can see it starting to compound, and then it starts to get real big, and then all of a sudden it's up around about $4 million. You do the same thing from a $50,000 account. Obviously this is going to be quite impressive, but again, remembering even though these are impressive figures, even though these are impressive figures, one second. Sorry, mail, just can't do two things at once, talking and typing. So even though these are impressive figures, so what I've done here is just multiplied it by 1.43, so 43%. Look what we started with. We're just basing this on 30 points a year. So very impressive figures, but based on just something that's very, very achievable. And all of a sudden, $50,000 account turns into a $63 million account in 20 years, or even after 10 years, it's nearly $2 million. That might be way under what you're looking for. It might be way more than what you're looking for. What the point I'm making is have some vision and see where this can take you. You might start off with $10,000 or even $3,000. Once it gets to sort of $10,000 or $20,000, going ahead and borrowing $50,000 or something like that, and getting up to that $70,000 mark here, say in 3 years' time, and then in 10 years after that, you're sort of down around making over $1 million a year. That's in 5 to 10 years' time. People go to uni for that sort of time, and you can build a big business just starting off with some really basic, simple structure here. Like starting off with some 30 points a year, and then just building upon it year after year. It's not like you're having to make more points every year. You just got a vision for the future, and you're starting off small and just making sure you build upon it every single year. Okay, so remember that's sort of just a little bit about compounding, just to sort of remember to have that vision and really go ahead and work these figures out for yourself. 43% might be way more or way less than what you are prepared to make in a year. Whatever it is, make sure it's achievable and just get going with it. Like I said before, it's not if you're going for 2-3 points a week and you sort of keep finding yourself pulling up short and almost going backwards. Well, take a step back and just look at it, 30 points a year or something like that. Okay, so to finish off, just want to have a quick look at this. This is going to be a little bit difficult to explain. What I want to really do here is just really show the point that part 2 of risk models is just thinking outside the box and just working with what you got and looking at ways to make better. Okay, so all I've done here is what I did is sat back and looked at the first PowerPoint of the day. Okay, so as a base system, it works pretty well. But then I noticed it goes through these patches where, November and now we're in December so far, so over the last, say, 5 or so weeks, the PowerPoint's copped an absolute flogging. It's going through its worst losing streak of the year. In fact, if all you did was take PowerPoints, you'd be down quite a bit. But if all you did is took power fades, you'd be up quite a bit. Then there's other sort of sections of the year, maybe a couple of weeks at a time, where the power fade works really well, but the majority of the time the PowerPoint works well. So obviously this market's come down. They like to have a bit of a bounce, and that sort of entry as a majority works. Okay, that's just from pulling out the figures and doing some trialing and testing. It's very obvious that the first PowerPoint of the day overall works. But how can we make it a little bit more efficient, where we find sort of build an indicator that tells us, when a few times when we should actually take a power fade over a PowerPoint. So that's what I set off to do. Try and find something in regards to that. I want to base it on my objectives. Okay, so as a trader, I know what I want to achieve. I want to build some sort of indicator that tells me at certain times when to take a power fade. So what I believed is that, sort of the base of this, and again, it comes back to trial and error. Not, this happened to work quite well, so I'm showing it. There's a lot of things that don't work as well. So it's just about not being afraid to fail, but thinking outside the box, thinking of something that in relation to these markets that kind of makes sense and that it should work, and then going ahead and testing it and seeing if it does work. Okay, so I believe that if you look at these markets after seeing sort of these real extensive periods where the power fade worked quite well, even though it didn't work really well over an entire year, there's periods where it worked well. So I believe that the market goes in sort of patches where power points work well, and then once the power fades get on a roll, pushing straight through that first power point, that seems to continue to happen for quite a few weeks at a time. So what I did is tested, and I basically, from the start of the year to the end of the year, just listed with the power fade column, PowerPoint column, just purely on 8 ticks, not whether it got filled or break even trades or anything like that. Just go, okay, each trade, did it get to the 8 tick mark, and putting it down if it did or didn't. Okay, so that means what I've got here is basically a list of what works. So either the power fade worked or PowerPoint worked. Obviously both can't work at the same time, but of course there's going to be many times when both fail as well. Okay, so if I just scroll down, I know too through the projection, the numbers might be a little bit hard to read, but hopefully you'll still get the point. Here it is here. So trades, just bold that. So trades, over this last sort of 11-month period, there was actually 223 trades. If all you did was take the power fade trade, 71 times out of that 223, it got to 8 ticks. Okay, the PowerPoint, you can see there, obviously over the year it worked a lot better. It did about 30% improvement on the power fade. It worked 106 times out of the 220 times. And then as far as both not working, about 46. Okay, so then it was just a matter of going through that and seeing if there's some sort of relation between the market getting a roll along. So what I did is gave it a bit of a color code. Every time it was green, is the PowerPoint worked. Every time orange, the power fade worked, and every time it was white, neither worked. Okay, and then what I did is listed some little numbers down here, down the side. So basically, this is the PowerPoint column, this is the power fade column. And then I just did a sum formula, added up sort of both columns and minused it from each other, and that's what this column here is. So whenever you've got a positive number, it means the PowerPoint has got a roll-along effect, and whenever you've got a negative figure, it means the power fade's got a roll-on effect. Then what I did is just averaged it out. So worked out with these figures down here, and hopefully you're keeping with me, but I'll make the point at the end here. Averaged it out. So I go, okay, over the last 15 days, added up the power fades and power points, what one came out more profitable, and looking at that each day. So what I mean is over the last 15 days, adding up all the power fades that worked, all the power points that worked, taking away, is that figure positive or negative? And that tells me which one is on more of a roll. Okay, and doing that over the last 15 days each day, doing it over the last 12 days each day. So I've got an average. So each day you just move forward, you just drop the day from however long the average is. So if it's 15 days, dropping the day from 16 days ago and adding on the latest day and just moving down like a moving average. Okay, and doing it with a 15 moving average, a 12 moving average, a 7 moving average, a 4 moving average, 3, 2. Okay, and what I've discovered is that really these small averages to me didn't make a lot of sense. I did want to test them, but it proved to be a bit too noisy, too much going on. And I've sort of highlighted it here with this two. If you can sort of have a look here. Okay, I've got here the average for looking at the power fade PowerPoint, and then the average over 15 days, and you can see what's highlighted in yellow is the one that's working. So highlighted in yellow, you can see the PowerPoint working most of the time with the average 15. On the average 14, the power fade, every now and then it's coming up, but it's quite random. It's coming on and off. Sorry, so the point I was making is with the smaller averages, it's chopping quite a bit between PowerPoint and power fade. Okay, that's when I think about what I'm trying to achieve here, as far as an entry that just looks at occasionally taking the power fade entry when it's on a roll. That's what I'm not after. This smaller average here when it's chopping and changing, because what it's going to do is take on take a lot of power fade trades, and that's going to really drop the overall result of the system, because it's not sticking with the solid entry, which is the PowerPoint. Okay, so I want to stick with that most of the time, but just find say 10-15% of the year when the power fades on a roll. Okay, so I could start to see straight up the small averages weren't worthwhile. I worked with, again, it's trial and error, just going through a few things. This took over half a day to work out and produce and use trial and error and recording and testing. But a lot of the information's already there that I've previously recorded, so it's just about running it through the system. So I found an average of 15 days worked quite well. So if I scroll down through it, you'll see a couple times power fade there. All of a sudden, here's a big section, sort of in June, where it said take a power fade. Back to the PowerPoint, one random little one there, and then here we go. Here's November, and if you continue through December, it's saying stick with the power fade. So all of a sudden, as an indicator, this started to represent a little bit what I'm looking for. Okay, and that's just about refining it. So what I said is, okay, let's take away these random ones here like this. So when it does say, let's try and stick with the PowerPoint, when it switches over to the power fade, skipping it. So if the first one comes up like this, skip it, and only start to take power fade when it comes up 2 times in a row. Okay, so then it has this little bit of random noise. It leaves it out. Okay, so what I'm trying to do is pick up here of times. Now all of a sudden it's starting to show me when the power fades are on a roll. So scrolling down, PowerPoint, one power fade. So I skipped that one. Then it had 2 times in a row, so I'm onto the power fade here just for one spot. Then it skips straight back to PowerPoint, so back onto that. Here says power fade, skip it once, and then onto the power. But then continues being power fade. So this is obviously saying that power fade's on a roll, so get on it. Back to the PowerPoint. Skip this one because it's just the once, and it didn't get another power fade, so that's just a bit of random noise. So that it's eliminated by the new little refinement in rules. And then November, obviously just stuck with the power fade, so that's when I want to be trading it. Okay, so that was sort of as a base. So I looked at that, and then down here's a few different results as to how it improved the system, and all of a sudden it started to show signs of improvement by, first of all, the average 15 improving, but then using the sort of little skip rule where you eliminate those noise days and only take it when it's 2 days in a row. It started to improve it even more again. So as a base, it showed signs, so it's something to work with. It showed potential. So then I flip over and go, okay, let's actually test this on real information and take the actual data and include profit targets and things like that. So that's what this little bit of information here. So this is November and June. Okay, so overall in November, if you just took the power fade, when it said to, you would have been up 7 points. If you just continue taking the power point over that period, would have been down 11 points. So in this period when just the PowerPoint system was having its worst losing streak by a long shot, this new indicator was telling me to take power fades, and as a result, that's an 18-point turnaround just there. In the June period, that smaller period, what happened? Both would have worked out profitable, but that power fade didn't actually add too much. It actually was, by taking those power fades, it was a little bit detrimental to the system. It still would have been better off taking the power points. But you can't have it 100%, so I would have actually been 7 points worse off by taking the power fade. Because there was a couple of break-even trades there at this particular point, my profit target was, the markets were moving quite a bit, so my profit target was bigger. So I got a few break-even trades which sort of let the power fade side down. But again, it's having a longer-term view, and what happens is the main sort of culprit was that November period, and that was dealt with. So even though there was the June period, it was 7 points worse off. It was, by taking the power fade, it was 18 points better off in November. Overall, over an entire year, there's an 11-point difference. So that's what I was talking about before, how create some rules or some indicators, some personal indicators based on my objectives as a trader, sort of thinking about what I want to achieve, thinking so outside the box, starting with something, working with it, refining it, developing it. If it shows potential, keep on working with it. If it doesn't show potential, you just give it a flick, move on to something else. And all of a sudden, something was starting to be developed. And then if you make 30, 40 points in a year, 50 points a year, whatever you make, here's an extra 11 points. There's an extra 20-25% return. It makes a massive difference. And that's what I mean. Depending on your contracts, 11 points can be worth thousands and thousands of dollars to you. Okay, so the point is that I want to make here, it's just an example. It's not to take the figures literally, and even if it's sort of the figures are, if you're a little bit confused there, because obviously I'll explain it quite quickly, and it's something that you need to sit down and really get explained to you quite well before you're going to really understand it. But the point is, hopefully you can see as an example, there's many things you can do through risk models, and that's the whole point of this entire course, to take risk models, work with something, think outside the box, work with your objectives, and find ways to improve the system. And this is an automatic indicator. This is something that's quite, it's very automatic. It's very easy to, from this now that's been developed, it took half a day, but from this, it's very easy to see when the power fade's on a roll and when I need to switch the power fade. But when that's not on a roll, I want to stick with the base of the system, which is the power points. And as a result, um, you know, efficiency is really increased. So expectancy is increased. Frequency is still the same, so it's not like I'm taking any less trades. That's a good thing. Return on investment has definitely increased, and drawdown, which that's another side. We have to go through it, and develop that side of things. But drawdown has been improved too. So I've actually taken what would have been the worst losing streak of the entire year, and really dramatically reduce that drawdown. So actually one of the biggest impacts that this would have had, and I haven't actually worked out exactly yet, but even though this made an extra 11 points, something that's going to really be that's going to benefit very well from this is the drawdown factor. Which is something that I spend a lot of time on making sure I've got my drawdown side of things covered. So yeah, hopefully you get something from that example. So that's that's it. That's the year done, guys. Like I said, congratulations, well done. Just keep on working hard, keep on moving forward, developing yourselves, your mindset, refining your systems. Take this example, run with it. Remember, risk models is what it's all about. Work with that base, find that base, and then always look of ways to improve it. Don't be a stranger. Come into the trading room. If you need anything, give us an email. And we're doing pre-market sessions where we're just basically focusing on risk models and looking at ways to develop risk models in the pre-market sessions. So more than welcome to come in and check those out and continue learning that way. So have a great Christmas and good luck in your future trading.